Well, good afternoon, everyone. This is Bob Brooks, host of the Prudent Money Radio Show. Today has been another wild, wild day. And just for reference, it's April the 7th, a very wild day on Wall Street. And I attempt to get crammed into a 30-minute show, everything that I think that you need to know. What I don't get crammed into this program, of course, we'll carry on tomorrow and talk a little bit more about it. But a lot of things happen. The volatility was out of control today. Probably, no, in fact, not probably. It was the most volatile day since COVID of 2020, when we had that wild stock market crash in March and April of 2020. But today was no exception. And at one point this morning, we found all four market indexes in bear market territory. So this means that you've got to know for a fact, this is the risk that I'm taking, this is what I'm comfortable with, and what changes should I make to get that to happen. And in this environment, I would strongly suggest that you take those moves and make sure that you know exactly how much risk that you're taking. And if you need to make any changes, of course, the Pop Culture Finance will tell you, don't make any moves. You can't time the market. This is not market timing. This is reallocating assets to reflect maybe your new risk level. So if you need any help with doing that, or would like an opinion, or like me to take a look, just make sure that you go to prudentmoney.com. There is a link at the top of the front page. It says Ask Prudent Money, and send me an email, and with your information, I will be happy to schedule something with you at no cost, of course, and go through what your options are. If you have any questions about anything that's going on in this environment, please let me know at prudentmoney.com. Hope you enjoy the program.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, another wild day on Wall Street. What happened to your money? Today we're going to take a look. Stay tuned for Prudent Money. Afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you got a question for me, I'm sure you do have questions after everything that's been going on the past, let's say call it about a month and a half. You are welcome to go to the website at www.prudentmoney.com, and there is a link at the top of the web page that says Ask Prudent Money. Send your email in, and we'll get you taken care of. That easy. That's all at the website, www.prudentmoney.com. Well, today was absolutely, the best way I could describe it, absolutely wild in the stock market. It reminded me a lot of what happened in March of 2020 with the COVID crash, where the market was up, could have been up 400 or 500 points. Well, Dow Jones Industrial Average, since a lot of people watch that, 400 or 500, 600 points up, and then 2,000 points down, and then 300 up, and then 500 down, and then ended, something like that. It was very, very wild. At one point, due to some fake news being released, the market went from being down literally as bad as 1,700 points down to being up 300 to 400 points. And it was an 8% swing from the bottom to where it went to the top, and then it went negative again. I mean, that's how bad the volatility was today. And we saw that, COVID 2020, we saw that during the financial crisis. It's just kind of unreal to see it again. And it makes me it makes me think that the nature of these big swings and how the market works, the question it brings to mind is, have things changed to where not that bear markets will go away, but have things changed to where bear markets they do as much damage, they go down as far as they've always gone down, 45, 50, 55, 60%, but they rebound quicker. And it just makes me think the way the structures of the markets work and that kind of thing, if we're going to see that again this time. At one point this morning, we had all the major indices in a bear market. And that's what I've talked about on more than one occasion here over the past month and a half, is we're looking to answer this question. Is it a correction? Meaning, is it going to be a situation where the market drops 10 to 20% and then recovers? Or is this going to be a full-blown bear market where it loses beyond 20%, which is where it was this morning, and then it fails to recover and goes down much, much, much further? And we're starting to get a few more clues that it may be the market's going to go down into a bear market cycle. We're going to talk about that today. But the S&P 500, the Dow, and the Nasdaq, well, two of the three ended up recovering and did not close in a bear market, which is what's important to notice. But the S&P 500 was down about 0.25%. The the Dow Jones Industrial Average was down nearly 1%, and the Nasdaq was pretty much flat for the day. So what was interesting is what happened in the bond market. Now, I probably when I'm looking at indicators, I'm looking at things that are happening, the combination of events that are happening in the markets, in order to come up with a reasonable cause for what's happening, so that you can make forecasts and that kind of thing. I got to tell you, I look at this situation and it just doesn't make any sense to me. And the one thing that and we'll start with, it doesn't make sense to me, is that interest rates were up today. Now, let's walk through what that means. If during times of financial crisis or during times of volatile markets, what investors tend to do is they tend to buy bonds. And if they buy bonds, if money flows into the bond market, that means bond prices go up and interest rates go down. And it's going into the safety of bonds in the bond market. What ended up happening today is that bond prices went down on probably no question, the most volatile day since 2020 in March, COVID. Bond prices went down and interest rates went way up. And it's interesting because this is something that influences and affects the mortgage rates, of course. I was watching over the past 5 or 6 weeks how interest rates have gone down, which has been very welcome by people in the real estate business. I was thinking about Mark Pfeiffer, who's been on my program every month. He comes on and talks about the real estate markets and how they're keeping their fingers crossed that this might be something that sticks. Unfortunately, I don't think that it will stick. I think we're going to see interest rates go back up, and that interest rates have just kind of been interest rates have kind of been going up and down for the past six weeks, and that you're going to start to see them go up in more of a trend for a number of reasons. But there's a lot. There's a lot to process. That's for sure. And the question comes down to, where are we in this cycle? And remember, we talk a lot about the cycle. And the cycle is, if you imagine a circle going round and round, and the markets have been doing this for tons of decades, ever since the stock market was invented, if you will. They've gone in circles where they start at the very bottom of the circle, and they start to go up on the left-hand side of the circle, and it gets towards the top, and it's when everything's out of balance, everything is overvalued, the stock market, and then the market goes down the right-hand side of the circle, which means it's going down, it's losing money, and it's gone into a bear market cycle. I believe that we're beyond that top, and we're in the thick of a bear market. Now, how quickly this goes and completes the cycle is anybody's guess. And I also could be wrong as well. So, but it seems more and more like that as we watch this thing unfold. Now, one of the things the market had to deal with we'll say the last 5 to 6 days, and I think it was a very interesting revelation for the markets, that there's always been two saviors for the stock market that they will come out at the end of the day and do something that will lift the market back up again. And both of these saviors have shown up and nothing has happened. And that's a key tell as to what's really going on, because there's been a bunch of times where the market is literally saved by some news release, by something the Fed has done, something the president has done, and there has been none of that at all. We'll start with the Fed, because the Fed has saved the day so many times. And this time, Fed Chairman Jerome Powell last Friday addressed the media, and what the market wants him to do, wants the chairman to do, is to lower interest rates. Now, you can't really. You got to be careful if you're the Fed, if you're the Federal Reserve Board, who takes care of interest rate policy. I mean, they determine which way interest rates should be going, and they've had to be very careful in this process, because we have a situation where we've got the starting of weakness in the economy, and depending on how this thing pans out, may end up in a recession, and the prospects of ongoing strengthening inflation, which these tariffs these tariffs actually cause. So you've got what's called stagflation starting to occur. And so Chairman Powell, and rightfully so, said, hey, we can't make any rash decisions. We can't make any big moves. We got to wait and see. And they're in a situation where they have to wait and see what the data ends up being, what the direction of the markets, the interest rates, the growth in the economy, and make do something with that information. Hey, this is Bob Brooks. We're up against a break. Stick around. I'll be right back.
Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
Hi, I'm Jan Markell, host of Understanding the Times. We're very excited to be a part of Bible School Radio. I hope you will join me Saturday, 10 a.m., for cutting-edge guests and the latest information to help you discern the truth, even the inconvenient truth. We'll help you understand our times and contend for the faith. That's Understanding the Times, Saturday at 10 a.m., right here on Bible School Radio or anytime at olivetreeviews.org.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. I was talking about the two saviors of the day, and one is the Federal Reserve Board, and they didn't give the markets anything. And so, I think that is literally the first time in 32 years I've actually ever seen the Fed not try to help out even in the least. I mean, it's very unusual. Obviously, there's probably times where it's happened. I just missed it, but it's very unusual when it does happen. And then there's President Trump. He's always known for being very market friendly, and he is about the furthest from market friendly in this, at least in this term. And the fact that he came out with kind of a shock and awe, if you remember that phrase, a shock and awe strategy as far as these tariffs go. Do you realize that, in fact, I'll back up and tell you, parlay into something that happened today. Last week, when he released the tariff information, if you add it all up, China would have to pay 54% in tariffs for every product that they sold to the United States. 54%. They came out and they fought back with another 34% on their tariffs for us. And President Trump came out today and said that they either remove that 34% or he's going to bring up tariffs another 50%, which would be 104%. It's quite unbelievable. I mean, he said today that he is not going to back down, and he's going to carry this out. And boy, don't know what to think about that, but we'll see. He's got guts. I'll give him that. But that is definitely not market friendly, and I think that the market is looking at this from the standpoint of, if he'll do this, what else will he do that will be market unfriendly? If he would pull out these kind of tariffs and do this kind of thing, then there's no telling what he'll do to get what he's trying to achieve, what he's trying to achieve. And always go back to and remember, what's that do? That increases uncertainty. The markets hate uncertainty, but it does create uncertainty in a very, very big way. So last night, when the market closes and opens for what's called futures trading at 5 o'clock, and when the market opened last night, it was down 1,500 points. The Dow Jones Industrial Average was down 1,500 points. If you ever wanted to see what the market's doing in the after hours of the actual market running during the day, you can always go to cnbc.com, and there is a tab that says pre-market, and you can see what the markets are doing and where they're likely to land. Okay, so where we go, we'll see what happens tomorrow. So far, the more disturbing event today is that like I said this morning, you had every major index in bear market in their own bear market territory. So let's talk a little bit about margins. This is something that I've talked about in the past, and one of the things that we discussed when we talked about margins, and I'll go over again what I mean by that, is that investors, when they get out of control with margin investing, that's a sign that the market is in trouble. And sure enough, January of this year, there was more margin debt on the books than ever before. I mean, it was a record amount of money that was taken out in margin. And basically what margin is, it's debt where you as an investor would borrow against your investment account, and you have to keep it under a certain amount of debt. And if you cross that debt, you have to sell some of your investments to cover that debt to get it back below that line. And it's called a margin call. And what nobody is really talking about is the damage that the margin calls are probably causing investors who are carrying quite a bit of debt. The reason that an investor would do that is because he or she is very bullish, positive on the stock market, and so that will be interesting to watch and see as that plays out. But another day at the office as far as the markets and pop culture finance, they were. When things are going on like they are, I watch keep CNBC on in the background and listen to just about everything throughout the day, except when I'm on phone calls or in meetings. But I try to keep those days light to see what's going on. And in full force was Pop Culture Finance, basically telling you to stay in the market. Don't worry about things. You're a long-term investor. And probably the worst piece of advice. And I get why they give this advice, but I still think it's the development of a very bad culture in the investment community, and that is, don't look at your statements. I was talking to somebody at the gym the other day. And before all this started, he was talking to me. He said, "Hey, would you mind taking a look at my investments and telling me if you were concerned about risk, what you would do and do differently?" And never got to do that. I was talking to him today, and that was before the market. That was before February 19th when this decline started. I was talking to him today, though, and I said, "Well, have you taken a look at what's going on with your investment?" I go, "Oh, no, I'm not going to take a look at it. I'm going to stay away from it. I'm not going to go to my computer. I'm not going to look at it. And I'm just going to let this write it out." And the problem with that is if we have a full-blown bear market of 50 to 55%, you're probably going to wish that you'd have made a few changes. Now, what Pop Culture Finance will have you believe is that you're trying to time the market. And you're not trying to time the market. You're trying to decide how much risk that you really do want to take. And I'll be the first one to admit that timing of the market does not work, but this is not timing, but I will say, though, timing of the market, buy low, sell high, is someone who is running on luck to try to make that happen and make that work. Doesn't work the majority of the time. But this is about reallocating your money to take less risk, take more risk, whatever your risk profile is. And there is absolutely nothing wrong with that, but you've got to be able to see how your investments are performing, how much you're losing. Take the investor. And I think, and by the way, this is something that I'm sure most people in pop culture finance will disagree with, but I think that's irrespective of where you are as far as retirement goes. Obviously, the closer to retirement goes, you've got to be very sensitive to risk. But why take a ton of risk, even if you're younger? Why take a ton of risk when the opportunity to gain reward is so very small and the opportunity to lose is so big? It makes absolutely no sense whatsoever. And I'm thinking about doing a webinar here pretty soon about how to reduce risk and how to go through that process. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Do you ever wonder, in the last couple of weeks, as these tariffs have materialized, is what this really does mean between the U.S. and China? So China sells to us about, let's see here, $582 billion worth of stuff is sold to us from China. $582.4 billion. We sell to China $143.5 billion. Now, if you do those numbers, you do the math, there's a big deficit, and that's what's called a trade deficit when a country like China is outselling the U.S. basically, and and the difference between the two. We'll talk a little bit more about this tomorrow. There's a lot that I did have to cover, and we'll go for it tomorrow. This is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money